Welcome to Financial Market Insights for Traders, the podcast where we break down the biggest economic trends, market developments, and investment ideas to help you become a more informed and confident trader and investor. I'm your host, Sophia, and today we're taking a deep dive into one of the most important topics for anyone participating in the financial markets: macro scenarios for the second half of 2026. As we move through the second half of the year, investors and traders alike are asking the same question: what happens next? Will global growth continue to strengthen? Are central banks finally finished with restrictive monetary policy? Could inflation return as a major concern? And perhaps most importantly, how should traders prepare when nobody can predict the future with certainty? Instead of trying to guess exactly what will happen, experienced market participants use a much more practical approach known as scenario planning. Rather than betting everything on a single forecast, they prepare for several possible outcomes. Today, we'll explore three of the most likely macro scenarios for the remainder of 2026: the bull case, the base case, and the bear case. We'll also discuss the economic indicators worth watching and how investors can position themselves regardless of which scenario eventually unfolds. Let's begin with why scenario planning matters. One of the biggest misconceptions in financial markets is the belief that successful investing depends on accurately predicting the future. In reality, markets are constantly adjusting to new information. Inflation reports, employment figures, corporate earnings, geopolitical developments, and central bank announcements all have the potential to change investor expectations almost overnight. This is why professional investors, institutional portfolio managers, and hedge funds rarely rely on one prediction. Instead, they develop multiple scenarios, assign probabilities to each, and prepare portfolios that can perform reasonably well across a range of possible outcomes. Scenario planning for the second half of 2026 helps investors reduce emotional decision-making during periods of volatility. It allows them to identify opportunities before they become obvious to the broader market, improves long-term portfolio resilience, and provides a framework for understanding how different asset classes might behave as economic conditions change. Preparation has always been more valuable than prediction. Now let's look at the current global macroeconomic backdrop. The first major theme shaping markets is inflation. Compared to the inflation peaks experienced over recent years, price pressures have eased significantly across many developed economies. Improvements in supply chains, lower energy prices in several regions, and the cumulative effects of tighter monetary policy have all contributed to moderating inflation. However, inflation hasn't disappeared entirely. Services inflation remains relatively persistent. Wage growth continues in several economies, and commodity markets remain vulnerable to geopolitical disruptions or unexpected supply shocks. This means investors shouldn't automatically assume inflation is permanently under control. Even small surprises in inflation data can significantly influence financial markets. The second major theme involves central banks. After spending considerable time raising interest rates to combat inflation, many central banks are now entering a different phase of the economic cycle. Rather than continuing aggressive tightening, policymakers are gradually shifting their attention towards supporting sustainable economic growth. That doesn't necessarily mean dramatic interest rate cuts are coming. Instead, many economists expect a cautious and data-dependent approach, with policymakers carefully monitoring inflation, employment, and broader economic activity before making each decision. Every central bank meeting remains important because interest rate expectations continue influencing stock valuations, bond yields, currencies, mortgage costs, and corporate borrowing expenses. Another powerful structural trend is artificial intelligence. Artificial intelligence remains one of the strongest long-term investment themes in global markets. Businesses continue investing heavily in automation, cloud computing, semiconductor manufacturing, cybersecurity, machine learning, and productivity software. Unlike many short-term market cycles, AI represents a structural transformation of the global economy. Increased productivity has the potential to improve corporate profitability across industries, ranging from healthcare and finance to manufacturing and logistics. Government spending also remains an important consideration. Many governments continue investing heavily in infrastructure projects, renewable energy, semiconductor production, defense capabilities, and digital transformation initiatives. These investments provide ongoing support for economic growth, but also raise questions about rising government debt and long-term fiscal sustainability. All of these themes combine to shape the macroeconomic environment entering the second half of 2026. Let's now explore the first of our three scenarios. The bull case assumes the global economy successfully achieves what economists often call a soft landing. In this scenario, inflation continues to decline steadily without triggering a recession. Central banks gradually reduce interest rates, consumers remain confident, businesses increase investment, and corporate earnings exceed expectations. Labor markets remain relatively healthy, unemployment stays low, global trade expands, and ongoing improvements in artificial intelligence continue boosting productivity and profitability. This combination creates one of the most supportive environments possible for financial markets. Technology companies could continue leading market performance as demand for AI infrastructure remains strong. Industrial businesses may benefit from increased capital investment. Financial companies could experience stronger loan growth and improving credit demand. Small cap companies often perform particularly well when borrowing costs begin falling because they tend to rely more heavily on external financing. Emerging markets may also attract increased investment as stronger global growth improves trade activity and capital flows. Commodity demand could strengthen alongside rising industrial production. If investors believe this scenario was becoming increasingly likely, they might consider increasing exposure to global equities, maintaining investments in innovative technology companies, adding cyclical sectors such as industrials and consumer discretionary businesses, expanding international diversification, and gradually reducing excessive defensive cash positions. Of course, optimism should always be balanced with sound risk management. Now, let's consider the base case, which many economists currently view as the most likely outcome. Under the base case scenario, economic growth continues, but remains relatively moderate compared with historical averages. Inflation continues declining overall, although occasional upside surprises may occur. Interest rates move lower gradually rather than aggressively. Corporate earnings continue growing, but performance becomes increasingly selective across sectors and individual companies. Consumer spending remains stable, supported by relatively healthy employment markets, even as households continue adjusting to higher borrowing costs than they became accustomed to during previous years. This balanced environment often produces more selective financial markets. Rather than seeing broad-based rallies across nearly every sector, investors increasingly reward companies with strong balance sheets, healthy cash flows, consistent earnings growth, pricing power, and sustainable competitive advantages. Dividend-paying companies may also attract greater attention as investors seek both reliable income and long-term capital appreciation. Portfolio diversification becomes especially valuable under this scenario. Rather than concentrating investments in one sector, investors may benefit from combining global equities, investment-grade corporate bonds, government bonds, dividend-focused companies, infrastructure investments, carefully selected technology businesses, and sufficient cash reserves to capitalize on future opportunities. The goal isn't to maximize returns under one specific outcome, but rather to build resilience across multiple possibilities. Now, let's turn our attention to the bear case. Although it may not represent the highest probability outcome, every investor should understand potential downside risks. The bear case assumes economic conditions deteriorate more rapidly than markets currently expect. Several developments could trigger this outcome. Inflation could remain more persistent than anticipated, forcing central banks to delay interest rate cuts. Geopolitical conflicts could escalate, disrupting global trade and supply chains. Energy prices could rise sharply due to production disruptions. Corporate earnings could weaken significantly. Consumer spending might slow as household confidence declines. Financial sector stress could emerge, or unexpected political uncertainty could undermine business investment. Even one major event could quickly change market expectations. Historically, bear markets tend to involve falling stock prices, higher volatility, weaker corporate earnings, widening credit spreads, and increased investor demand for government bonds and other defensive assets. Companies carrying high levels of debt often experience greater pressure during periods of economic weakness because refinancing becomes more expensive while revenues may decline. During these environments, capital preservation becomes increasingly important. Investors may choose to increase allocations to defensive sectors, maintain higher quality fixed income investments, hold additional cash reserves, avoid excessive leverage, rebalance portfolios regularly, and remain focused on long term investment objectives rather than reacting emotionally to daily market headlines. Preparation before volatility arrives almost always proves more effective than attempting to respond once markets are already under pressure. Regardless of which scenario ultimately develops, investors should monitor several important economic indicators throughout the remainder of 2026. Inflation reports remain among the most influential releases because they shape expectations regarding future monetary policy. Employment data provides valuable insight into labor market strength and consumer spending potential. Central bank communications, including policy statements, speeches, and meeting minutes, often provide clues about future interest rate decisions long before actual policy changes occur. Corporate earnings reports reveal how businesses are performing under current economic conditions, while management guidance frequently offers early signals regarding future demand. Purchasing Managers Index surveys, commonly referred to as PMI data, provide early indications of manufacturing and services activity and are closely watched by investors seeking evidence of accelerating or slowing economic momentum. Consumer confidence surveys also deserve attention because confident consumers tend to spend more, supporting retail sales, travel, housing activity, and broader economic growth. One of the greatest advantages of understanding bull, base, and bear cases is the ability to construct a portfolio capable of performing reasonably well regardless of which scenario unfolds. Rather than concentrating risk, diversified portfolios spread investments across multiple asset classes and sources of return. That may include domestic and international equities, government and corporate bonds, dividend-paying companies, growth-oriented technology investments, infrastructure assets, and cash reserves that provide flexibility during market corrections. Regular portfolio reviews ensure investment allocations remain aligned with both changing market conditions and long-term financial objectives. Finally, it's worth remembering that successful investing is rarely about making perfect predictions. Markets will always surprise us. Unexpected events will always occur. The investors who consistently perform well over time are usually those who remain disciplined, diversify thoughtfully, manage risk carefully, review their portfolios regularly, and continue learning throughout changing market cycles. If you'd like access to professional-grade tools to support your trading journey, visit crystalbellmarkets.com/platform and explore Crystal Ball Markets' world-class, cutting-edge, user-friendly trading platform. Whether you're just starting out or already an experienced trader, you'll find intuitive features, advanced charting, and powerful market analysis tools designed to help you make more informed trading decisions. And if you'd like to continue building your knowledge of trading, investing, macroeconomics, financial markets, and trading psychology, be sure to visit rss.com/podcast/crystalbellmarkets. You'll find a growing library of beginner-friendly podcast episodes designed to help traders and investors build confidence while staying informed about today's rapidly changing financial landscape. Thank you for listening to Financial Market Insights for Traders. I'm Sophia, and I hope today's discussion has given you a clearer understanding of the macro scenarios that could shape the second half of 2026. Until next time, stay disciplined, stay informed, manage your risk carefully, and remember that successful investing isn't about predicting every market move. It's about preparing for whatever the markets may bring.